I do think there is some contagion risk here. I think there's other firms that had, first of all, there's firms that had money just sitting in FTX, and that's now going through bankruptcy court. So that's been bad. I mean, Multicoin came out publicly and said that they had 10% of their portfolio sorted on FTX. There's other firms that Alameda may have had loans with, and those firms are probably struggling. I don't want to say who, but we have received a couple of inbound calls from other people trying to get emergency financing. There's people who may have just totally different from FTX and Alameda. They may have just had their own portfolio that they took margin or leverage on to buy crypto. And now as the prices have come down a little bit, they're getting stopped out.
After the turbulence of the past week, the cryptocurrency market is gearing up for another week of chaos, uncertainties, and confusion. As you would recall from our previous videos on the issue, it all began with news of Sam Bankman-Fried's crypto firms FTX and Alameda Research going insolvent. According to statements from FTX's Telegram channel, the crumbling cryptocurrency exchange was hacked a few hours after it filed a Chapter 11 bankruptcy claim on Friday. A few hours after news of the bankruptcy filing, a flood of FTX users began reporting sudden $0 balances. Several on-chain analysts also started tracking the transactions as millions of dollars exited the exchange. Ray Miller, the exchange's general counsel, released this statement on the firm's Telegram channel. FTX has been hacked. Chat is open. Don't go to FTX site as it might download Trojans. Note that some funds were retrieved. On Twitter, the general counsel stated, investigating abnormalities with wallet movements related to consolidation of FTX balances across exchanges, unclear facts as other movements not clear. We'll share more info as soon as we have it. According to on-chain analyst ZachXBT, the hack was to the tune of $383 million. While the situation continues to unravel, Brian Armstrong, Coinbase's chief executive officer, recently appeared on the All In podcast to discuss the collapse and the possibility of another crypto contagion that would swallow more trading firms, lenders, and exchanges. Please watch, share, and like this video. Also, ensure you've hit the like button, subscribe to the channel, and turn on post notifications for more videos like this. Thanks and enjoy the video.
My understanding is, and again, this is from people I've talked to, and I spoke with Sam and CZ briefly during this, but I didn't get details from them. I got it from other people.
You spoke to them this week.
Yeah, I mean, this was all going down. I mean, I spoke to Sam about, he was trying to raise emergency financing and things like that. And I spoke to CZ about why he was considering buying the asset. I thought it was a bad idea. But my understanding of what happened at this point, and again, I don't have all the facts. This is just my understanding, is that, FTX was in a position where they had this market maker, Alameda, that was investing in risky things. And that's fine. Like market makers, hedge funds, they're designed to take more risk. It appears at this point that back during the last shakeup in the crypto industry where, Terra Luna and Voyager and Celsius and Three Arrows went under, it appears that Alameda took a big loss at that time as well. They may have even been underwater. And instead of just saying, hey, this hedge fund's going to blow up too, which would have been unfortunate. People would have, Sam would have lost money. It's embarrassing, but it's not illegal for a hedge fund to blow up. It happens with some regularity. Instead of just letting it blow up, it seems like at this point, he took customer funds. Yeah, so it seems they had this solvency issue. And instead of just letting it blow up, Sam basically said, hey, we have a bunch of customer assets over here at FTX. Or he somehow basically made a loan from FTX into Alameda to try to prop it up. I don't know why he did that. I mean, that's the moment in my mind where he crossed the line into probably committing fraud. And I think he probably lied to users, lied to investors, and he went around and tried to bail out these different companies like Voyager and BlockFi and to sort of prop up this thing. And maybe he thought he could trade his way out of it or something. I'm not sure, but that seems to be where the mistake was made. If you're a regulated financial service business, but you're not a bank, we're regulated as a trust company, a money transmitter, et cetera. You're required to hold customer assets one for one, denominated in the asset. So in other words, if you say the customer has one Bitcoin, you have to hold one Bitcoin. If they say they have $100, you have to hold $100. And so that's the case with Coinbase. You don't have to take our word for it, by the way. You can look at our audited public financial statements as a public company with an independent, Big Four accounting firm who went to go verify all of that. And that's what various custodians and exchanges, that's what they all should be doing. By the way, if you're regulated as a bank, you can actually go invest some of those, but there's very strict regulation around that and capital requirements and whatnot. And we're not a bank. So we hold one-to-one. Now, if you're an investment fund or a hedge fund or something like that, then you can try to take positions in different coins and different assets, and they could go up and they could go down. You may lose your investors' money, but there's no such thing as the customer assets being involved in that. There needs to be clear segregation of those customer funds and from what an investment fund would be or corporate funds. And that's where they got in trouble. They basically commingled customer funds with their hedge fund.
Classic fraud.
Yeah. Can you explain the contagion, by the way, just so we can, because everyone's been talking about the contagion and understanding what's next. So that's what I just want to, because I think people are going to be asking that a lot this weekend.
Yeah, so I do think there is some contagion risk here. I think there's other firms that had, first of all, there's firms that had money just sitting in FTX, and that's now going through bankruptcy court. So that's been bad. I mean, Multicoin came out publicly and said that they had 10% of their portfolio sorted on FTX. There's other firms that Alameda may have had loans with, and those firms are probably struggling. I don't want to say who, but we have received a couple of inbound calls from other people trying to get emergency financing. There's people who may have just totally different from FTX and Alameda. They may have just had their own portfolio that they took margin or leverage on to buy crypto. And now as the prices have come down a little bit, they're getting stopped out. So that's all been very challenging. And I again, just for the sake of clarity, I should say that Coinbase did not have any material exposure to Alameda FTX or FTT token.
During the podcast, Armstrong discusses the possibility of another crypto contagion. According to the Billion business executive, he has already received calls from several crypto firms seeking emergency funds. And all this is in addition to BlockFi's announcement that it was blocking withdrawals because of the FTX situation. We believe we will see similar announcements in the coming weeks as other firms scramble and fail to avoid the fallout.
Because this is really the crux of the issue from a legal standpoint, right? I mean, I remember when I was doing PayPal like 22 years ago, and the company was like 6 months away from running out of money. I remember the lawyers told us really clearly, you cannot use customer deposits to fund the operating expenses of your business. In other words, if this business ends up going bankrupt, you'll still have all the customer money there and they'll be able to get it back. And, it was really clear, like, hey, if you use customer funds to pay for the burn of the business, to operate the business, that is a do not pass go directly to jail type offense. And so, like, that's really the heart of this. Now, I read in some articles covering this that the way it worked is that Alameda had a bunch of these FTT or these FTX tokens called FTT. And they basically use that as like a marker, as collateral. So they basically borrowed, like 6 billion of customer funds from FTX. And then they use their own token to then as collateral. So
to backstop it.
Yeah, exactly. And then what happened is apparently like CZ got wind of this and he owned a whole bunch of these tokens. And he signaled that he was going to dump it, and the price basically went down. And so now all of a sudden the collateral for the customer loans was insufficient, and then there was a run on the bank. And
by the way, this happens in the public markets a lot as well. So like when you see heavily shorted names, or when you know that certain hedge funds are on the brink, other hedge funds will go in and essentially force a margin call and a stop out, because then it's what causes all of these runs. And if you look actually inside of GameStop, the reason why you got all this gamification in the GameStop equity and a bunch of these other names was in part because of this dynamic. Folks that are highly levered, folks that don't have the right matching of risk. And what happens is they're solvent but illiquid. And then if you run the instrument into the ground, they both become insolvent and illiquid all at the same time.
Look, I don't know who inside FTX's and its orbit of companies actually knew that the fraud had been taking place. It would not surprise me. I have no idea, to be honest, but it would not surprise me if FTX US people and employees had no idea that this was happening. I'm imagining if Sam was doing, when he started doing this, he probably wanted to keep it to a very small group. Otherwise, this is the kind of thing that leaks and the whole thing blows up. Now, that being said, I don't necessarily think FTX US is worth anything as a business right now because of the brand being so tainted. And there probably was not great separation of these entities in the sense of, like, did they have truly separate boards and beneficial owners and governance? And Sam seems to have, it appears that FTX didn't really have a CFO or maybe even like a real board or anything like that. And so it's hard for me to imagine.
We found on Reddit, there was an article that appeared that said that the head of compliance at FTX was also the head of compliance at a poker site called Ultimate Bet, which in the 2010s did this exact thing, apparently, some version of this where they went in and they looked at hole cards of poker players, and then a few employees inside the business would basically play against these folks, knowing what the hole cards were, ran this cheat, stole millions of dollars. Somehow that person found a way to be head of compliance at FTX.
Yeah.
10 years later, which is incredible. But back to this question. So now what happens now is you have the international business and the US business and Alameda Research all rolled up into this one frozen entity, right? With now regulators having to. So do you know what happens in a process like this? Like, is it that the DOJ and the SEC get priority, or is there some international monetary, like who unwinds all of this? How do people get their money back, if at all?
Yeah, so I'm not an expert at this, but my high level understanding is that the bankruptcy courts will essentially, and I believe they filed bankruptcy in the US, which is an interesting thing. I didn't know why they did that versus Bahamas. But anyway, the bankruptcy court will basically go through and try to find any assets of value. So, I mean, they still have some tokens and value. They have a venture portfolio. I think Sam owned 9% of Robinhood. There's various things that they may own. And then they'll kind of auction those off to various bidders on distressed assets and then try to distribute those funds to the customers. I don't know the exact process beyond that, though.
Though we still don't have the full information about what really went down, it is certain that greed, recklessness, and a disturbing God complex play huge roles. According to recent reports from Reuters, FTX legal and finance teams discovered that SBF, FTX founder and former CEO, implemented a backdoor in the exchange's bookkeeping system using bespoke software. The said backdoor reportedly allowed SBF to alter the company's financial records through silent commands that went unnoticed by other FTX executives and external auditors. According to the report, the 30-year-old reportedly used the backdoor to move $10 billion to Alameda Research without triggering internal compliance or counting red flags. Reuters also noted that SBF denied the allegations of the backdoor and the $10 billion transfer from FTX to his trading firm. In text messages between the former crypto billionaire and the news agency, SBF reportedly said this about the transfer. "We didn't secretly transfer. We had confusing internal labeling and misread it." Reuters also noted that he didn't clarify his statement or respond to questions about the missing funds. What are your thoughts on the latest developments in the FTX collapse? Please drop your comments and observations in the comments section below. Also, sure you hit the like button, subscribe to the channel, and turn on post notifications to stay updated on the crypto markets. Thanks for watching.